Okay, welcome to the ninth topic that we'll be looking at, which is financial instruments. And I would say it's a big topic to get things kick-started again, but luckily you guys had the week to sort of get back into uni rhythms because this is a relatively complex area. So it is something where I suppose it is worth coming along, and you guys are here, so I'm preaching somewhat to the converted, but it is something which is worthwhile spending some time on. The topics after the mid-semester exam do become more complex, so it is worthwhile, spending some time with these. Now, the first thing I actually want to do, and this has come up because of a couple of questions we've been getting, and I think they're reasonable questions. I've listened to some of Rob's slides, and I know he does talk about, he did talk about OCI and consolidated versus comprehensive income, but I think it is actually worth just to point out because this becomes important as we move into, I don't know why that keeps happening. This does become important as we move into hedging. And just to help you, again, just to revisit this, we've had a couple of weeks off just to pick back up on it. So what we've got here is an income statement. This is for Qantas. The things, basic idea, just revenue, expenses, we're all comfortable with that. And what ultimately we end up with at the bottom of the income statement, as you guys are well aware, is just net profit. So in this case, it's statutory profit, but net profit after tax is the number that we end up with in profit and loss. What OCI is, and we're going to be touching on it again today as we go through the hedging situations, is OCI comes underneath profit and loss. Ultimately, it feeds into what is total comprehensive income. So this is in total, in terms of all the sort of income type events that have happened, Qantas has had a loss of $276 million and equity has dropped by that much. But of that 276, $32 million of that was other comprehensive income. So there is all your normal stuff which happens, your revenue and expenses, and that comes through into profit and loss. And then there are some other things. And if we look through that list, things like foreign currency translation of controlled entities, things like transfer of hedge reserve to the income statement. There are events which happen which, for whatever reason, the AASB has said, we don't think they should actually be part of profit and loss, so let's hold them out and just put them into OCI. Now, this is important because if a company has a choice, and they don't always have a choice with this sort of thing, but if they had a choice to have something have a profit and loss impact versus an OCI impact, if it's a negative thing, they're going to want to push it through OCI because that way it doesn't hurt their profit. If it is a positive event, they would probably want to go through profit and loss because profit and loss is the thing when we're looking at company performance that we're interested in. So when the media talks about it, when analysts look at performance, this is generally the number that they're looking at. They're not looking at 276. So I just wanted to just bring that to your attention because we have been getting questions about what is OCI and why is that different, how does that fit into all of this? So hopefully that just gives you a bit of background to where it works. Okay, so what we're going to be doing today is looking at why the accounting for financial instruments is problematic, what financial instruments are, and then just how do we account for financial instruments at a relatively basic level, and then looking at some hedge transactions. Now, just as a precursor to all of this, and if we sort of step outside the work we're doing right at this point, the issue for a lot of people with this stuff is not necessarily the accounting per se. The accounting, once you get your head around what you're dealing with, the actual accounting is relatively straightforward. The difficulty that we see, and we talk to a lot of students over many years about this, the difficulty is actually getting your head around what the economics of what we're looking at is. What is the actual transaction? What are the cash flows? What's actually happening? Because if you can get your head around what's actually happening, the actual accounting for it becomes way easier to figure out. So if you have to spend time sort of when you're looking at this coming up, hopefully sooner rather than later, try to think about what's actually going on, and that will help inform you as you go through the accounting side of things. So financial instruments, look, they can be really easy. Shares are a financial instrument. So if I have BHP shares, That's a financial instrument. The accounting for that is relatively straightforward. There's not a lot of complexity with that. A bank loan, just a normal, I go to the bank and I borrow money to buy my car. Well, I did have a car loan, I paid it back now. But when I went to the bank to get a car loan, that's a financial instrument. That's becomes a little bit trickier to work out, but it's not that complex. As we start to move into futures and options, credit default swaps, CDOs, as we start to move into these other instruments, which some really clever people, potentially too clever for their own good, have started creating these instruments, the accounting has had to try to keep up with how we deal with that. And there have definitely been shortfalls in terms of how the accounting has worked. So before we get to the next slide, what I want to do really quickly is just, because it becomes important for later on, I just actually want to talk about two types of instruments which you may have heard about. And at their heart, they're reasonably straightforward what they're doing, but they've had some quite big impacts. So because of that, I think it is worth just talking about them, and we'll look at some of the impacts of them later on. So, before we get going, just, not that I expect you to answer questions on this, I'm not going to hold you to a higher standard, but just to get a sense of it from my point of view, how many of you guys are doing finance as your other major? A couple. So some of these things may be more familiar to you than others, but that's not to say that we're expecting everyone to be, to be knowledgeable on this at this point. But some of you may have heard of the term securitization, just looking at finance, so there's a few nods. One of the things we're going to talk about, and one of the big issues that led to, I suppose, well, lots of things led to the GFC.